In 2018, a Canadian billionaire paid about $117 million for a Formula One team that was so broke, it had already collapsed into bankruptcy once. 7 years later, that same team was valued at $3.2 billion. That's not a typo. That's a 28 times return on a business that, on paper, loses money almost every single year it operates. Business where the product gets deliberately destroyed at 200 miles an hour, sometimes multiple times a season. A business where you're legally forbidden from spending more than a fixed amount of money, no matter how rich you are. So how does that math work? How do you build one of the most valuable sports franchises on the planet out of a sport that's famous for bankrupting its owners? Today we're pulling back the curtain on the economics of owning a Formula One team, the real costs, the real payouts, and the real story of how a nearly dead race team turned into a multi-billion-dollar empire. Let's get into it. Let's start with the obvious question. What does it even cost to run one of these things? Since 2021, Formula One has operated under something called a cost cap, a hard legal limit on how much a team is allowed to spend per season. For 2026, that number sits at $215 million. That covers the car's development, aerodynamics, race operations, and most of the engineering staff. And this is the part people miss, that cap doesn't cover everything. Driver salaries sit outside the cap. So does marketing, hospitality, and the team's 3 highest paid executives. Add all of that back in, and a top team's real annual operating costs can comfortably push past $300 million once you count star driver salaries that run into the tens of millions. And that's just to operate. Buying your way into the sport in the first place is its own mountain. When Cadillac joined the grid as an 11th team in 2026, it had to pay a one-time entry fee of $450 million, money that gets split among the existing teams as compensation for diluting their share of the prize pool. That's the going rate just to get a seat at the table before you built a single car. Okay, so the costs are brutal, but how does a team pull in revenue to cover it? There are 3 main rivers of cash flowing into a Formula One team. The first is prize money. Formula One as a whole generates over $3.5 billion a year, and roughly a third of that, north of $1 billion, gets split among the 10 teams based on where they finish in the championship. Finish higher, earn more. It sounds simple, but the gap matters enormously. Slipping just one position, say from 5th to 6th, can cost a team $8 to $10 million in a single season. In a sport where every department is fighting for cap space, that swing can be the difference between hiring another engineer or not. The second river is sponsorship. This is where it gets genuinely massive. McLaren, for example, set a record in 2025 with over $148 million in sponsorship revenue across 53 different partners. Everything from tech giants paying $40 million a year for logo space, to tobacco companies, to crypto exchanges. Title sponsorships alone, the kind where a company's name sits on the car itself, now regularly trade in the neighborhood of $100 million a year for the biggest teams. The third river is the quiet one. The team's own valuation. Selling small ownership stakes to private equity firms and outside investors has become one of the most lucrative moves in the sport, and it's exactly how our billionaire from the intro made his fortune. So, how? $117 million became $3.2 billion. Let's actually walk through it, because this is one of the great business case studies in modern sports. In 2018, Force India, a scrappy, underfunded midfield team, collapsed into administration. Lawrence Stroll, a fashion and retail billionaire, led a consortium that scooped it up for around 90 million British pounds, roughly $117 million, plus some assumed debt. He didn't just buy a race team, he bought a shell and then poured money into it. He rebranded it into Racing Point, then rebranded it again as Aston Martin, tying it to the legendary car brand. He built a new factory. He built a state-of-the-art wind tunnel. And in 2025, he pulled off arguably the biggest coup in the paddock, hiring Adrian Newey, widely considered the greatest race car designer alive, away from championship-winning Red Bull. None of that spending counted as profit in the traditional sense. Most years, the team operated at a loss, but it was building something far more valuable than quarterly earnings, a brand. And brands attract investors. In late 2023, private equity firm Arctos Partners bought a minority stake, valuing the team at $1.2 billion by 2025, a fresh round of investment pushed that number to $3.2 billion. Stroll's original investment, the one everyone thought was reckless in 2018, had multiplied nearly 28 times over. On paper, in under 7 years. This is the part traditional business logic struggles with. The team wasn't making money every year, and it still turned into one of the great wealth generation stories in modern sports. Because in Formula One, you're not just buying a race car business, you're buying a stake in one of the most watched, fastest growing entertainment properties on earth. Supercharged by a little Netflix show you might have heard of called Drive to Survive. Now, before you go liquidating your savings to buy a midfield team, let's talk about the risk nobody puts in the highlight reel. First, most teams still lose money on operations year after year. Even elite outfits post underlying losses. The team's value rises because of what it represents as a media and brand asset, not because its annual books are healthy. Second, performance is brutally, publicly unforgiving. Spend $250 million perfectly. Make one aerodynamic miscalculation, and you can finish the season near the back of the grid, watching a rival with the exact same budget lap you on live television in front of hundreds of millions of viewers. Third, this is not a liquid investment. You can't sell your F1 team stake on a Tuesday afternoon the way you'd sell a stock. These deals take months of negotiation, and the buyer pool is small, mostly private equity firms and a handful of billionaires. And fourth, the one that should scare you most of these valuations are still largely paper gains until an actual controlling sale happens. The eye-popping numbers you read about are built on minority stake sales. Nobody has actually bought the entire Aston Martin F1 team for $3.2 billion yet. It's a valuation, not a bank deposit. Here's the honest verdict. It depends entirely on why you're buying in. If you're chasing quarterly profit like a normal business, Formula One will disappoint you almost every year. But if you're playing the long game, building a global brand, riding the sport's explosive growth in the United States, and positioning yourself to sell a stake to investors who are desperate to get into one of the hottest properties in entertainment, the returns can be staggering, as Lawrence Stroll proved. It's less like owning a sports team and more like owning an extremely fast, extremely loud, extremely expensive startup, one that happened to circle a track 200 times a race. Here's the thought I want to leave you with. 100 years ago, the smart money bought land. 50 years ago, the smart money bought media networks. Today, some of the smartest money on the planet is buying into a sport where the product depreciates by design, the spending is capped by law, and the whole business loses money most years because the brand itself has become the real asset. That's the strange, brilliant logic of modern Formula One. You're not really buying a race team. You're buying a piece of one of the fastest growing entertainment franchises in the world and betting the rest of the planet catches on before you do. If breakdowns like this are your thing, this is exactly what we do every week here on Economic Files, pulling apart the numbers behind the biggest deals in sports and business. Hit subscribe so you don't miss the next one. See you there.